Then when we're looking at fixed income, so when we're looking at the subject fixed income, it might seem a little dry to some people, but I find it very, very interesting. So if you notice over here, the interest rate and bond prices are on a seesaw. Basically, the idea is when interest rates fall down, bond prices goes up. When interest rate goes up, bond prices goes down. I know it might seem a little weird, but just let me give you an example. So if, say, for example, I do an FD, fixed deposit, let's say, at the rate of, let's say, 6% in the market for 10 years. Now, after a year, let's say the fixed deposit rate, FD rate in the markets increased to 7.5 or 8%. I'll feel very irritated because I'll be at a loss because I blocked my money to get 6% rate, 6% interest rate for the next 10 years. Had I not invested, had I not done that 10-year FD and waited for another year or so, I would have been able to do it at a higher rate of interest. I know I'm just giving you an example of FD, but in order to explain how it works with the bonds, right? I know you can break an FD earlier and do all of those things. I know all that. But are you understanding the idea? So in bonds, what happens is basically you're blocking the interest rate for, let's say, the next 5 years if you're buying a 5-year bond. Now you will get that 7% interest, but what if interest rates increase in the market later? So in that case, you will be stuck with lower rate of interest. You have blocked your money at lower rate of interest. So when interest rate increases, now if people are investing, they will be benefited, not the ones who had already invested in bonds earlier. So interest rate and bond prices, they move in two different directions. So fixed income is a very, very interesting space to look at. So when you're looking at an investor as well, so either you're making investments in equity, you could be directly buying stocks, or you could be investing through mutual funds. Second is you could be investing into PPF, your provident fund and all. You could be investing into fixed deposits and all. So they are all a part of fixed income. Broad investment categories, equity, fixed income. Now when you're looking at fixed income, what happens is we look at how the central bank is behaving. Interest rate becomes very important factor. Inflation, foreign exchange, all these factors, especially when you're making investments abroad. I'm not talking about you as an individual, but there are, governments who invest in different countries. There could be Canadian sovereign fund, as in the Canadian government fund, which could be investing into Indian bond market. So central bank works with the interest rate, tries to influence interest rates in a particular way. And central bank's job is to manage interest rate, inflation, particularly inflation is the most important aspect that central bank tries to manage. So based on that, your interest rate fluctuations happen, as in the central bank basically controls the monetary supply, and based on the money supply, they try to influence the interest rate, because of which your bond prices will get impacted. So interest rate is one of the most important factors when you're studying fixed income. And we have thousands and thousands of millions of dollars invested in the fixed income space, bond markets and all. There are so many debt mutual fund which invest in debt, government debt and corporate debt. That brings me to corporate bonds. So a lot of analysis is needed in terms of evaluating corporate bonds, how they are and whether which company is risky. Rating agencies work in terms of rating AAA, AA, triple B, BBB, etc. for the rating of the bonds, how risky the bonds are, how risky it is to give loan to this company. The entire banking sector is based on the fixed income space, the loan space, the credit risk and all. So all those things are a part of fixed income. It's very interesting. It's very, very interesting. A lot of money related calculations, a lot of interest related calculation, a lot of credit risk related calculations are required. So that is your fixed income. Then when you're looking at alternate investments, so normally when an investor is investing, we're broadly looking at equity, fixed income, and everything else gets classified under alternate investments. So equity, as I told you, is going to be where you're investing in stocks, etc., maybe directly or through mutual funds. You're buying shares or you're buying mutual funds and all. You're investing in fixed deposits, pension funds, provident fund, PPF, etc. They're all fixed income securities because the income is fixed. Your interest, your returns are relatively fixed. It's not based on the performance of the company, how good or bad the company is doing. And everything else gets classified under alternate investments. The two most popular alternate investments when you're looking at an average Indian household, let's say, is going to be gold and real estate, so the jewelry that you own. And now there are multiple ways of investing in gold, sovereign gold bonds and holding bonds like shares in your demat account, gold ETFs and all. We'll discuss these more in detail later, but there are multiple ways of investing in gold apart from jewelry as well. And I would love to discuss some time about, jewelry, because a lot of debate that happens in terms of whether or not you should invest in jewelry in terms of gold and all. A lot of miscommunication is there rather, I would say a lot of misinformation is there, not miscommunication, rather deliberate misinformation is there, because people don't even understand the structure of the society, how to invest in gold, why people have invested in gold, how does it create generational wealth, etc. What are the challenges with investing in gold, particularly physical gold and all. Anyways, but we in India particularly have a huge amount of investment in gold in the form of jewelry or in the form of gold directly as well. And second is real estate. Very important, the house that you live in. Again, there becomes a debate that whether you should live only in rented space or house. Again, I'll just give you a simple example. You would find a lot of hypocritical people who talk about you should spend on experiences and all that, and the same people would talk about not to own a house and rather stay on in a rented space or something. But what if, me staying in my own house is a major amount of experience. I'm experiencing my house on a daily basis because I sleep in my house every day. So there's a lot of factors you need to see. I would sincerely recommend you a book called Psychology of Money by Morgan Housel, and you need to understand much more and more in depth instead of the flimsy kind of understanding of personal finance. So real estate and gold commodities basically are one of the two very prominent categories of alternate investments. So equity, fixed income, gold, real estate, predominantly we are investing our wealth in these four asset classes. And then even when you're looking at startups and all, that is going to be a part of alternate investments. Private equity, so you can invest in a stock called Zomato, but you cannot invest in Swiggy right now because Zomato is listed, it is public equity, but you cannot invest directly in Swiggy. You have to invest it privately. That is why we call it private equity. So your venture capital and your startups and everything is going to be all a part of alternate investments. When you're looking at real estate, for example, private equity, commodities, so these are all, even paintings, cryptocurrency, infrastructure bonds, because they're related to the infrastructure asset, they're all going to be a part of alternate forms of investments. So broadly, we're looking at equity, fixed income, and all the other asset classes belong to the alternate investments. Now, when you're looking at the different investments, equity, fixed income, alternate investments, so how do you put all of those together is basically your portfolio management. And we often talk about do not put all your eggs in one basket. Why? Because if there is a loss in one asset class, then the other one is going to be able to balance it out. So for example, if I put all my money in one stock, and if that stock generates a huge amount of loss, I will have a major loss in my portfolio. I might have a major problem in terms of managing my retirement funds and all. But if you allocate your money into different asset classes, gold, real estate, equity, fixed income and all, in a proper proportion, depending on how much risk you can take. So in that case, if even one asset class is not doing well, if there is a major crash in the economy or something, then you plan your investments in such a way that one's loss is going to be balanced out by the other's profit. So we try to do that. So how do you structure a portfolio would also vary depending on whose portfolio we are talking about. So whether we are talking about an individual's portfolio, that individual could be a young guy or a very old person. So a person who's 30 years of age, who's going to be working for the next 30 years, let's say 25 years, let's say, he can take much more risk because you have 25 years, the markets might be increasing or decreasing. And on an average, you will be able to average out your returns. And in the long term, you need to invest in equity. You need to reduce your taxes. You need to generate a good amount of return. You need to fight inflation. You need to do all of those things. But an old person, let's say at the age of 60, he might not be comfortable investing too much in equity. He might have to invest less in equity and more in bonds and all, because he's already retired and now he's liquidating his investments to manage his retirement expenses. So we'll have to look at an old person and a young person in two different ways. Somebody who has a huge amount of money and less amount of money also we have to see in different ways. How much can you afford to lose? What is your lifestyle expenses? So your retirement planning, etc. So individual to individual, your portfolio and portfolio planning would be very, very different. And there are institutional investors also. Pension funds also have to invest. So for example, when I'm depositing money in a PF account, a provident fund account, that needs to pay me an interest. So they have to manage that money. When we people are depositing such huge amounts of premium in life insurance companies, LIC premiums and all of that, they have to invest that premium amount, generate return so as to take care of all our claims. So how do these institutions manage their portfolio? So banks, companies, they have a huge amount of treasury balance, and also how do they invest and how do they manage their portfolio and all is also something that we need to see. So institutional investors. So there are individual investors and there are institutional investors. Next, we'll talk about a subject called derivatives. So it's about managing risk. So risk is not about, aaj kuch tufani karte hain, jumping across buildings for a bottle of soft drink. But when you're looking at risk again, so what happens is, say, suppose who's going to take care of my family after me? So I buy a life insurance. Who's going to take care of the hospital bills, or how will I manage the hospital bills in case I fall ill? I take a health insurance. I'm trying to manage a certain kind of risk that me or my family can face in the future. Similarly, there are a lot of risks involved when you're looking at the companies. Suppose we're talking about MRF tires. Now, these people are going to be impacted. Their profit margins will be impacted by the rubber prices. So the rubber prices will increase. The profitability of MRF tire will go down. So how do I manage the risk of commodity prices changing? My raw material commodity prices changing. So I have to use something called the derivatives. Suppose Infosys is there, or let's talk about an importing company, oil price increases. If oil price increases, Indigo or and Air India might have a little bit of a problem because oil is one of the raw materials they use. So how do they manage that? Or importing companies are there. We import a good amount of oil. So how would that impact? Foreign exchange rates will impact your exports and imports. So how do I manage the risk of the exchange rate fluctuations? What if the exchange rates are fluctuating against me? The exchange rates are fluctuating, which is not in my favor. Then what do I do? How do I go about it? So managing those risks from the company's perspective, interest rate risk is there, commodity price risk is there, foreign exchange risk is there, credit risk is there, variety of risks are there when you're looking at businesses, financial institutions and all. So how do you manage that risk? Using something called derivatives. Derivatives is a very interesting but a very extensive topic. Options, futures, forwards, swaps, etc. And also for speculation, for betting, for speculation, I would rather use the word speculation. In order to make money in the markets and all, people use a lot of derivative products and all. So that is also there. If you want to do well in the long term, ethics becomes extremely important. This guy is Rajat Gupta. After the board meeting, he called up his friend, gave very, very crucial information about his company to his friend, which he was not supposed to, obviously. And his friend traded on that information, Rajratnam, who was a hedge fund manager, and he made a lot of money out of it. And then this guy, Rajat Gupta, he was put behind bars. So now what happens is, never take short-term decisions, never go greedy, never compromise on ethics, because your entire life could be jeopardized for it. You might be able to fool somebody or make money in the short term or do well in the short term, but you will never ever do well in the long term. So please make sure, and especially when you're looking at, for example, during COVID, banking and finances were one of the most important and one of the emergency services, for example. It's very important that in this kind of profession, you're very, very ethical, in every profession for that matter. So recently something happened where Axis mutual funds, fund managers, they were doing some trades unethically before they were executing the trade for the mutual funds, and huge amount of fine and cases and everything going on. So please be very, very careful.